Hello, I believe that crypto is a reasonably interesting technology that has been perverted and misused by a bunch of grifters and crooks to scam as much money as possible out of regular people. Today I will argue why I believe that, and perhaps more importantly, why you should care even if you do not intend on buying into the scam. During the big crypto hype wave of 2017, I was 14 years old. At the time I was completely gripped by the hype. I even bought a tiny amount and then forgot my wallet key after the first big crash, since I thought no one will ever talk about this again. But I was 14 years old, so I would have probably lost the key even if it was worth millions. By the time the next big hype hit, I was already old enough to know that get-rich-quick schemes do not work, or at least not if you're the one buying into them. I had seen this before, and to no one's surprise, the whole thing crashed after everyone realized how goofy NFTs are. After the bubble popped, I thought, surely now there is no one left in this world stupid enough to buy into this glorified Ponzi scheme. But this time I am afraid the crypto people might have learned their lesson. They know their tokens are worthless and the crash is ultimately unavoidable. So they have concocted a plan. The last two times all it took was a few crypto gurus shelling bitcoins to gullible people like my 14-year-old self. But this time it will not work. So instead of getting people to give them money willingly, the crypto shills have gone for the oldest trick in the capitalism playbook, the government bailout. Instead of convincing a massive amount of idiots to buy into a transparent scam, you only need to convince a few. That is, get the Federal Reserve or whatever national bank of choice to buy these worthless tokens from you at whatever the current exorbitant market price is, and voila, you have just converted a bunch of ones and zeros into cold hard cash. And that is why I am making this video. Because as long as it's just the so-called crypto enthusiasts that get rock pulled, I could not care less. But this time is different. This time they are out to steal public money. My money and your money. And that is where I stop being amused at people gambling their life savings away and start getting angry. Now that you have heard this introduction, you might think to yourself, oh, this seems a little bit far-fetched. But do not worry, I will go into detail and explain why I think buying cryptocurrencies as a reserve currency is a giant scam. To do this, I have split this video into three parts: the ideological, the technical, and the material. In the first part, I will discuss the ideological foundations of the crypto people. I will discuss their market radical ideas and where they came from. And I will discuss their perverted understanding of freedom and democracy, as well as their project of dismantling the state. In the second part, I will discuss the technical aspects of cryptocurrencies. I will explain how crypto works in detail and what the technical limitations are that make it suboptimal as an everyday currency. In my opinion, when crypto is criticized from a left-leaning point of view, there is often not enough emphasis on the technical details. How crypto works is incredibly important, because it is part of the myth that you do not understand how it works. In the 18th century, Wolfgang von Kempelen unveiled the Schachtürke, or Mechanical Turk, to impress the Empress of Austria. The Mechanical Turk was a chess-playing automaton. This machine did indeed impress, but in reality it was just some dude in a robot costume. Crypto is the same. If you understand how it works, the magic is gone. Do not get me wrong, it is a very cool idea from a computer science perspective, but it's just not an efficient solution for the problems we have with our current financial system today. The third and final part is dedicated to the material, the actual reality. For all this talk of big ideas and revolutionary technologies, what is the actual real-world impact of crypto? I hope I am not spoiling too much when I say that all crypto has achieved until today is wasting an astronomical amount of energy and lining the pockets of crooks like Argentinian President Javier Milei. Also a quick note, in this video I will only discuss cryptocurrencies. I do not care about other blockchain related nonsense. So when I say crypto, I mean cryptocurrencies. Also, I will explain in the technical chapter why Bitcoin specifically is one of the technically least impressive cryptocurrencies. And since Bitcoin is by far the most popular, a lot of my criticisms will be directed against it. Even if there is some niche coin out there that is super energy efficient with close to no transaction cost, the big point of this video is to show that the price of a token is completely divorced from the actual reality of its technical merits. So what I'm trying to do is shit on the crypto shills and investment gurus, not on the possibly quite talented people that came up with this interesting computer science concepts. Because the technology has never really mattered at all. What matters to the crypto people and market radicals is money.
This is the chainsaw for bureaucracy. Chainsaw!
So let's now dive into the first part of this video. Here I will discuss the ideology behind cryptocurrencies. Again, what is important here is not necessarily the ideology of the people who created crypto, but of the whole sphere that appeared around it. The fundamental promise of crypto is actually quite beautiful, and at its inception it appealed to a lot of people. To a somewhat left-leaning person like myself, stripping power away from the monstrosity that is the global financial system is quite appealing. For every transaction we make in our modern lives, the crooks and thieves and a bunch of intermediate banks, as well as PayPal and MasterCard, all get a cut. The current system is opaque and inefficient. But due to the many technical limitations that I will outline in the next chapter, it was not the people who are critical of these inefficiencies that embraced crypto. Exactly the opposite happened. It was co-opted by the forces of global capital. Instead of freeing us from the clutches of large financial institutions, it became just another way for them to make money. These institutions like banks and hedge funds see crypto for what it is, a purely speculative asset. Also, there is an entire sphere of people that has formed around crypto. This includes libertarians, finance gurus, anarcho-capitalists, Silicon Valley technocrats, and any of that sort. And whether it's out of ideological conviction or just to make a quick buck through some pump and dump scheme, these people are all in the same business. And that business is to promote market radical ideas. To explain what these ideas are, I want to backtrack a little bit. The 19th century was the golden age of capitalism. This is the time where the great monopolists like Rockefeller with his Standard Oil thrived. Occasionally, a few workers would strike and demand absurdities like a livable wage, but these strikes could usually be crushed with a few hired goons. But then, 1929, the big financial crash happened. This was a massive shock because suddenly it was not just the poor who were impacted, but also the rich people who gambled and lost all their money in the stock market. Now for the first time the ruling classes had an epiphany. Maybe having completely unchecked financial markets is not a unproblematic idea that will never ever backfire. The response was an America dominated by New Deal politics and the economics of John Maynard Keynes. This means a lot of government spending in infrastructure and social programs. A few years later, the Second World War began. When the Americans found themselves involved, they needed to produce tons of armored tanks, shells, guns, and enough food to feed their population while all the men went off to die in Europe. To achieve that, they told the industrialists to pull their fingers out of their asses, stop trying to get even more astronomically rich, and contribute something to the war effort. This meant strict price controls and full employment. So to summarize, post-war America was shaped by strictly controlled financial markets, social economic policy, and high employment. To avoid social unrest and the spread of communism in Western Europe, the Americans implemented the Marshall Plan and shipped a bunch of their excess industrial production over the Atlantic. I will read you a passage from Yanis Varoufakis' Technofeudalism. I think he illustrates this time very well. The rise of the technostructure transformed American capitalism from a decentralized market society into a centralized economy with markets. It was precisely what the Soviet planners had always hoped to achieve but failed. And there's the irony. In the 1960s, a decade marked by an ideological and nuclear clash between America and the Soviet Union that almost blew up the world, Soviet planning principles were implemented with remarkable success in the United States. Irony has seldom taken a more effective revenge over earnest ideology. So the point is, the time where America prospered the most is where they were the closest to social economic policy and tried to restrict financial markets. So this worked well for the West, and radical free market ideas were not really mainstream anymore. But of course, like every time when something is mainstream, you will find people who dislike it. In Austria, there were a bunch of men who were quirky and not like the other economists. We call this group the Austrian School of Economics. This included among many Ludwig von Mises and perhaps most famous of all, Friedrich August von Hayek. These guys did not like the economic order at the time, so they and a bunch of others got together and created an exclusive little club, the Mont Pelerin Society. They met yearly here in Switzerland to discuss their economic ideas. I imagine it a little bit like a sleepover where they all sat in a circle in their pajamas, giggling, spinning a bottle, and whoever the bottle pointed to had to say what their favorite economist is, and then they would all pull on each other's hair because everyone wanted to say that Adam Smith is their favorite economist. Later they gossiped about how much social welfare sucks and how poor people should just pull themselves up by their bootstraps. Which is absolutely hilarious since, it's Ludwig von Mises. They all have like a von title in there. They are basically high-class people, right? So I bet they know a lot about pulling themselves up by their bootstraps. Hayek and his friends laid the theoretical foundations for what we call neoliberalism. This is essentially the economic model that dominates our world today. The dogma of neoliberalism is privatization and deregulation. By now you're probably saying, this is all very interesting, but what does it have to do with cryptocurrencies? Do not worry, I will tell you. Many people claim that crypto democratizes decision making. But in the next chapter we will see that it is not really democratic at all. It's just the person with the most money gets to decide. But when these market radicals say crypto is democratic, they are not lying. They actually believe that. The favorite slogan of the market radicals is that they are for freedom and democracy. What they do not tell you is that they have a completely different definition of what these words mean. For me, freedom is relatively vague, but it means something like freedom to believe what you want, freedom to be who you want to be, and most importantly, freedom from exploitation and coercive power structures. When I use the word democracy, I mean a system where every human has the same voice. But for market radicals, these words don't mean the same thing. Freedom for them means first and foremost freedom from any financial oversight by the state. This means freedom to pollute the environment as much as you want. Freedom to pay your workers just enough so they don't starve. Freedom from any taxation. Freedom to sell your food with a bunch of chemical sweeteners that are clinically proven to be cancerogenous. So essentially, freedom to do whatever the fuck you want as long as you are rich. And democracy does not mean that everyone gets a voice. It means that your opinion counts proportionally to how much money you have. You may have heard the phrase, vote with your wallet. That's exactly what that means. Now you should begin to see why market radicals love crypto. It is exactly that. We will see in the next chapter that in the proof-of-stake system, your influence depends on how much tokens you have. And since crypto is completely unregulated, you can hide all your money from the fiscus. But I want to establish a more direct line between early neoliberal thinkers like Hayek and modern crypto grifters. If you bear with me for a second, I will give you an example. In the 70s, a military coup led by Augusto Pinochet and backed by the United States overthrew the democratically elected government of Chile led by Salvador Allende. Today I will not go into the whole history of US-backed coups for the benefit of American business moguls. But what is important for this story is that as soon as all the leftists were in prison, a bunch of neoliberal economists swooped in like vultures to tell Pinochet about their market radical policy. One of them is the guy I mentioned before, Friedrich August von Hayek. I will read you a quote from Hayek himself where he is talking about Chile. As you will understand, it is possible for a dictator to govern in a liberal way, and it is possible for a democracy to govern with a total lack of liberalism. Personally, I prefer a liberal dictator to a democratic government lacking liberalism. This is a perfect example of what Grégoire Chamayou calls authoritarian liberalism. I will not quote him directly, but it's this. The idea is that the neoliberal types like to say, oh, we love freedom and democracy so much, but in actuality these concepts are completely incompatible with their economic policy. Yes, I know this still has nothing to do with crypto, but it would not be a YouTube video essay with an enormous amount of historical background information that is only tangentially related to the topic of the video. We're getting there, I promise. Hayek was not the only neoliberal thinker who met with the Chilean dictator. There was another one. His name is Milton Friedman. You might have heard of him. Milton Friedman also visited Hong Kong. I will read you a passage from Quinn Slobodian's Capitalism. Yet another was the celebration of the possibility of economic freedom without political freedom, or what scholars call liberal authoritarianism. Rabushka, Friedman and others believed the virtues of this model had been overshadowed by the overemphasis on democracy in the definition of the free world in the Cold War. As Friedman put it, democracy was not an end in itself. The believer in freedom has never counted noses. Friedman went on to create the Economic Freedom of the World Index, where he included a bunch of authoritarian countries. Again, this goes to show how these people do not have the same definition of freedom and democracy. As it happens, Friedman has an intellectual heir. Well, he's not only his intellectual heir, he's also his actual heir. His grandson, Patry Friedman. Patry Friedman is also a crypto bro, anarcho-capitalist, and LARPing enthusiast. He's friends with people like Peter Thiel, and now you see where all this tech bro Silicon Valley technocrat mindset comes from. It is all rehashed neoliberal ideas. I will read you another quote. To describe the creation of cryptocurrency, I don't have no fucking idea how to say this. To describe the creation of cryptocurrency, Srinivasan reached for the term we have seen earlier in the relation of the joint fantasy of David Friedman's medieval recreationism, live-action role-playing or LARPing. Bitcoin proponents had LARPed a currency into existence, he said. They had treated a line of code as if it were money, and enough people were convinced by the quality of their model that it became money. And I think there's no better way of describing Bitcoin. It's literally LARPing a currency. The neoliberals realized that you need a state to enforce the so-called free market. Because despite the name, a free market is not something that just naturally appears. The thesis of Grégoire Chamayou is to enforce this so-called free market that results in massive exploitation and wealth disparities. You need a strong authoritarian police force or the system collapses. Hayek and Friedman realized this when they aligned with the brutal dictatorship of Augusto Pinochet. But Friedman's grandson and his crypto bodies do not realize this. They do not believe in the state. These people have taken all the perverted ideas of what freedom and democracy means, but now they want to LARP their own country into existence by buying giant yachts or islands. And this is of course all based on crypto. The YouTuber Adam Something has some great videos where he ridicules these people, but I feel that I don't have any super original points to add to that, so I just recommend that you go watch that after you are done listening to me. But essentially the idea is always to create some physical location somewhere in international waters where you don't have to pay taxes. Or some goofy knockoff metaverse based on crypto. Inventing your own country so you don't have to follow any rules is the kind of stuff normal humans come up with when they are 10 years old and angry at their parents. So keep in mind what ideals these people have. It is important when discussing why these people love the crypto technology so much. They hate the state, they hate taxes, and most importantly, they hate any form of democracy where even poor people get a vote. I will give you another analogy on how the new generation of market radicals differs from the OG ones. In the beginning of the 20th century, Max Weber released Die protestantische Arbeitsethik und der Geist des Kapitalismus, or in English, Protestant Ethics and the Spirit of Capitalism. And there he points out how these two are connected. In Protestantism you have to work hard your entire life and do nothing that is remotely fun to get into the kingdom of heaven. And in capitalism the myth is basically the same. Work hard, pull yourself up by your bootstraps and you get to be rich. And of course everyone who is poor deserves it because they just didn't work hard enough. Both of these myths are of course complete horseshit, but this is the myth of capitalism that the neoliberals believe in. Perhaps one of the most hilarious things about the Catholic Church is that at one point they just said, fuck it, we're gonna sell indulgences, so basically tickets into heaven. I love this because it is so insanely cynical. They essentially said at this point, this myth of being a good person we are selling is so unbelievable we might just throw all pretenses overboard. This is exactly what crypto is. They realize that today everyone knows pulling yourselves up by your bootstraps is not realistic. Therefore, crypto is a ticket that promises to get you into metaphorical kingdom of heaven, or here, being rich. And here we get the Patrick Friedman generation. His grandfather was still realistic. He knew that he needed the power of a state to enable his market radical dreams. But the crypto bros and anarcho-capitalists grew up in a world dominated by neoliberal politics. Privatization and deregulation are already the law of the land. Therefore, they forget that they need a powerful state that is just there to enforce these rules. At least this has been the case since the inception of crypto. But recently this has been shifting. The crypto people are slowly realizing that abusing state power for your own benefit is actually a very good way to make money. This is where the horrible idea of buying crypto as what they call a reverse currency comes from. So to conclude this first part, from now on when I say you buy nothing when buying crypto, that is not exactly right. You are buying something. You are buying an ideology. You are buying a myth. When Javier Milei, the president of Argentina, scams his own supporters with a crypto rug pull and then goes around parading chainsaws with Elon Musk, they are doing the exact same thing the Catholic Church did 500 years ago. Selling stupid myths of savior to desperate idiots.
The Bitcoin is going to the moon, as we say, it's going to the moon. I want America to be the nation that leads the way, and that's what's going to happen. No, you're going to be very happy with me.
So let's now talk about the elephant in the room, the technological. Here I will give some quick context on how crypto actually works. Often when people talk about crypto, they leave out a lot of details on the actual technology behind it. either because they think it is too complicated to grasp, which might be the case if you go into actual detail on how you could implement this in code, but the high-level overview is not too crazy. The other reason one might not go into detail is because it demystifies the whole thing. It ruins the marketing. To someone who does not know what the blockchain is, it appears as some mythical space detached from our reality. It is some magical super advanced technology. But that is of course not the case. While as a programming enthusiast myself, I find it quite fascinating from a technical point of view, it is important to highlight that any technology comes with trade-offs. The main point I want to make in this section is that even though a lot of people call crypto a currency that is democratized through decentralization, in reality it is neither a currency nor democratic. Now let's start by getting a few little concepts out of the way. If you are interested in computer science, you will certainly already know them. But for anyone else, I will give a quick explanation of the two magical words that give crypto its name: cryptographic hash functions and digital signatures. We need these two because without them, this whole thing is impossible to explain, and as soon as you grasp them, it's basically free. First, hash functions. They are functions that take a arbitrary amount of bits and output a fixed amount of bits. Ideally, the output appears random. A hash function is cryptographic if it is computationally infeasible to generate an input that fits a specific output. The output is called the hash value, and computationally infeasible just means technically doable but not realistically with our computational capacity. So the useful thing about these hash functions is that you can easily check if the input data has been tampered with. So in simple terms, it's just a number that identifies a bunch of data. Now the second concept, digital signatures. This one is a little bit more complicated.
So, digital signatures. Originally, I wanted to explain it in a bit more detail, some math, some detailed explanation. But one of my friends, he saw my script, he read it and he said, "Oh, it's too much math, no one cares, don't do it in this much detail." I said, "Okay, I'm not gonna do it in so much detail, so here is the quick version of digital signatures without math for you, for your viewing pleasure."
Just imagine that the digital signature is a bit like a wax seal and the stamp is your private key. So anyone can see that something with your digital seal on it actually came from you. And what you do when you want to add a digital signature to a bunch of data is the following. You compute the hash value of the data and then encrypt the hash value with your private key. Now you can send out the data with your signature, and anyone who has the public key can check if the message really came from you. They can do this by decrypting the signature and checking if it matches the hash value of the data. This of course only works if you are the only one with access to the private key. In cryptocurrencies, these private keys are very valuable because they are essentially the password to your bank account. And the public key is equivalent to your bank account number. When you make a transaction and claim it comes from a certain account, you have to put your digital seal on it, and anyone can do a simple calculation to verify that the seal fits your account number.
That's basically all that the digital signature is. The math behind it is very cool, but I will spare you. I will link the Wikipedia in the description, so if you're interested in math, absolutely check it out. It's a very cool piece of math. So now we can get back to the original content.
Now, armed with the basics, we can finally start to explore the topic of this chapter. First, we must ask, what is the fundamental promise of crypto? What is the problem it is trying to solve? The appeal of decentralization is usually to take power away from some sort of central authority. In our case, this central authority is usually the state. Some national bank that gets to control the currency in your specific country. But it also includes various private financial intermediates that all take a cut. So the first promise is essentially that crypto will strip away a bunch of arbitrary power from the state and various financial institutions, by democratizing money and giving more control to you, the user. I believe that this promise has not been fulfilled, and I will tell you why. The second promise is far more fundamental. The name cryptocurrency implies that these tokens can be used as a useful and modern currency. But I will argue that crypto fails miserably to uphold even this very basic objective. My argument on why crypto fails to uphold its first promise mainly applies to relatively democratic nations. In my home country of Switzerland, the National Bank gets to decide how the currency is managed. And since the National Bank as an institution is accountable to the state and by extension the people, they have done a reasonably good job at keeping the currency stable and strong. As somewhat of a leftist, I do have a big problem with the control big financial institutions have over our money. But since I do have a reasonable amount of trust in the democratic institutions of my country, the obvious solution for that problem would be more government intervention, not less. The decision-making process in crypto, however, works quite differently. To explain this, I will once again have to get a bit more technical. The fundamental idea behind crypto is that every transaction is stored on a publicly accessible blockchain. I know this will surprise you, but the blockchain is made up of blocks. A block is just a bunch of data. In case of cryptocurrencies, it's a bunch of data about transactions. So whenever some new transactions happen, a block is created and added to the chain. Like I said, the blockchain is publicly accessible. It is not stored on a single central server. Everyone that wants to can store their own full copy. But because everyone can store their own version of the blockchain, we need a mechanism to make sure that no one is manipulating it. The first measure is very simple. Each block contains a hash value of the previous one. As a reminder, a hash value is a long number that uniquely identifies a bunch of data. If the data changes a little bit, the hash is completely different. With this, it is very easy to check that no blocks are missing and nothing has been modified. For example, without this measure, you could just remove a block with transactions you don't like. To make sure it's not possible to just add some bullshit transaction, every transaction has to be cryptographically signed. So you add your digital seal to any transaction you want to make. I will now simplify a bit and leave some stuff for later. Every time you want to add a new block with a bunch of transactions to the chain, you have to solve a very computationally expensive problem. This means you can just remove a block and recompute all the hashes without spending an insane amount of computational power. Spoiler alert, it's still very possible to remove transactions you don't like. Now, why is this all important for the decision-making process in crypto? The way changes in the system get made is if everyone who hosts their own copy of the blockchain agrees to the new rules. It is not surprising that not everyone always agrees. If some people disagree, the blockchain forks. This means two groups each continue to add to the chain in their own way. Now, on the small scale at which it was conceived, the system is very fair. But if we consider the actual realities of our world, it becomes more complicated. The reality is that an average user will have very little say in big decisions. The Bitcoin blockchain is large. It takes up multiple 100 gigabytes, which is doable for an average user. But the computational power needed to have even a chance at adding a new block is enormous. So the ones who are de facto in charge are actors with massive financial resources and huge data centers. Because when the currency forks, the money will always follow them. Here's a concrete example. In 2016, a bunch of tech bros wanted to create a decentralized venture capitalist fund called the DAO. They raised a massive amount of Ether currency. Their genius idea was to democratize venture capital by decentralizing the decision making. Everyone that had money in the fund could vote proportionally to their investment amount. So in short, they reinvented the wheel and democratized nothing, because that is exactly how investments have always worked. If you have more money, you get to decide. But they did achieve something, and that is a faulty code base. Someone figured out the vulnerability and stole millions of dollars in ether. Usually something like this would not be reversible. The fundamental idea behind the blockchain is that it is immutable. Everything that is written to it stays there, which basically means that if you are too incompetent to keep your crypto safe and get scammed, that's on you. That is not an idea that I necessarily agree with, but I can certainly see the appeal. The appeal is that the rules apply to everyone in the same way. It's like natural selection, survival of the fittest. The crypto people call this code is law. But as soon as the venture capital people from the DAO manage to get their money stolen, suddenly the core principles that justify this entire charade, they did not matter anymore. And they essentially got a bailout. Ethereum was hard forked. The branch that is now called Ethereum Classic is the one that kept their code is law principles intact. I will now let you guess, what do you think is the branch that is worth a lot more today? Obviously this is a rhetorical question. No one should be surprised that it's the one that throws their principles overboard to follow the money. To repeat what I am arguing for, I assert that the first fundamental promise of crypto is to democratize decision making by means of decentralization. But decentralization de facto means that users that may not be technically literate like your grandma are extremely vulnerable to scams. While the capitalist pattern of big organizations getting bailed out every time they fuck up is being replicated. And now you should begin to see why the market radicals we discussed in the last chapter absolutely love crypto, because it uses the exact same definition of democracy they have. That is, whoever has the most money gets to decide. And if you don't have money, you're shit out of luck. Now let's discuss the second promise of crypto. That is, how it fails miserably at being an actual currency. With one exception, Monero, that is mainly used to buy drugs online. To determine whether crypto can reasonably be called a currency, I will define a few qualities that I deem necessary for something to be called a currency. Before money was invented, people would just barter with each other. So, exchange goods and services for other goods and services. But I think it's clear that this is not particularly productive. So, people started to use stuff like gold and silver as a universally accepted medium of exchange. Gold and silver are metals that are quite heavy, so at some point we had the idea of using paper to represent the value of the gold. This was born out of a second need, which is also the second quality. A currency must be convenient to use. Then we abolished the gold standard. This has some benefits, but it also introduced a third problem. The value of a currency must remain stable over time. Now, I know that the Romans already debased their currency 2000 years ago, but that is not relevant to my point here. So let's now go look at some of the cryptocurrencies and see if they actually satisfy these criteria. The first one is universally accepted medium of exchange. Here I am not super strict. If I walk into a store in China and try to pay with francs, they will think I am stupid. So maybe a better name is widely accepted medium of exchange. There are actually a few online services where you can pay with crypto. I don't believe that any of those currencies is accepted in the real sense of the word, but I will be generous and say that at least Bitcoin and Ethereum can be considered close enough. And Monero for illegal transactions, as it is very hard for governments to track. It is actually quite an outlier in this space, because for many people no transaction fees, wait time or volatility in the exchange rate will compare to the inconvenience of having to go talk to some dodgy dude you barely know to buy your weed. But leaving that aside, I think the accepted medium of exchange criterion is by far the least interesting, so I will give it a pass. Let's move on to the second criterion, convenience of use. This is the most important one, because if crypto was the objectively most convenient way to conduct various transactions, we would not even have this speculation problem. So I will now explain the various problems with crypto's convenience of use. And before that is possible, I will once again have to elaborate a bit more on the technical aspects. Decentralization is not free, certain trade-offs have to be made. Earlier I said anyone can just add blocks to the chain by solving some math problem. This is partially true, but also a massive oversimplification. The problem is there are a bunch of different nodes. Nodes are instances of the blockchain. Now, ideally these blocks are always synchronized and have the same state. But this is not easy to achieve. For this purpose there is something called a consensus mechanism. It is a system that determines what the official version of the blockchain is. There are two main groups of consensus mechanisms. One is proof of work, the other is proof of stake. Proof of work is the original idea. It is the system that Bitcoin uses. And since it is extremely flawed, the other big player, Ethereum, has replaced theirs with a proof of stake system. But since that is more modern and far more reasonable, I will talk about it later. For now, what is proof of work? Ideally, the blockchain is linear. One block comes after the other and it does not split. But if everyone just added their own blocks whenever they wanted, it would be very hard to determine what the official version of this blockchain is. So the job of the consensus mechanism is to determine who gets to add the next block. If you want to add a block to the chain, you need to solve a cryptographic puzzle. Each block has a block header, which contains a bunch of metadata. For example, a time step, the hash of the previous block, and a so-called nonce value. This nonce value is just a bunch of bytes that do not mean anything. And this cryptographic puzzle is to find a specific nonce value, such that if you compute the hash value of this block header, you get a number that is smaller than a certain target. To be plain, calling this a cryptographic puzzle is extremely charitable. It's literally just generating random numbers and computing their hash value. Essentially the most nonsensical task ever. A computer doing crypto mining is essentially like Sisyphus pushing his boulder up the mountain over and over again, condemned to do a useless task for all eternity. But keep in mind, it's not just one Sisyphus, it's millions all solving the same problem at the same time. Because everyone doing this so-called crypto mining is competing to solve the problem first to be able to add a block to the chain. This of course has enormous energy costs, but I will elaborate on that in the chapter about the material. For now, it's just important to grasp that this task is inefficient by design. By now you might be asking yourself, why on earth would anyone want to waste their energy completing such a useless task? The answer is of course money. Because whenever someone creates a transaction, they pay a fee to whoever adds that transaction to their block. When this new block is mined, or the Sisyphus puzzle solved, the miner gets to add their block to the chain. They do this by sending out the block to all the other nodes. Remember, nodes are the other instances of the blockchain. When two blocks are mined at the same time, both miners send out their blocks at the same time, and it comes down to network latency where they reach first. Each node accepts the first valid block that reaches it and continues mining from there. For a while there are two competing paths where some continue mining from block A and some from block B. This is called a fork. The longest chain is always the correct one, so after a while when a new block is mined, this fork resolves itself. But here we have a very fundamental problem of crypto. The spread of new nodes is limited by network connection, so the speed of the internet. If blocks are mined too fast, you get a bunch of forks and the entire system stops working, because the nodes cannot agree anymore. So to ensure network stability, this time to mine a new block, or as it is very creatively called, block time, is artificially increased. The difficulty of the mining puzzle gets adjusted according to a target block time. This block time is in place to give all the nodes time to synchronize. In Bitcoin, this is about 10 minutes. This means, on average, one block is added every 10 minutes. You can probably see where this is going. The Bitcoin network is bound to be perpetually congested. When the network is congested, the competition to get your transactions verified increases, so the transaction fees skyrocket. Now you should start to see why Bitcoin is such a horrible currency. There is a massive trade-off between transaction throughput and network stability. So the resilience of this decentralized network that is apparently so fundamental to the idea of crypto. So to get back to what I am arguing, I defined convenience of use as a fundamental property of a currency. Bitcoin fails miserably. It is completely unusable for actual day-to-day transactions. The wait time is long, the fees are too high, and the entire proof-of-work system is horrendously inefficient. But I am not the first one to point out these problems. I have already mentioned that proof-of-stake is the other system. This alternative consensus mechanism tries to fix some of the inefficiencies of proof-of-work. Here it gets decided who gets to validate the next block based on how much currency that person stakes. Staking currency means you put down some amount as collateral to make sure you are behaving honestly. This selection process is random but weighted by the amount of currency you stake. And also sometimes some other things to make sure it's not always the guy with the most tokens who gets to validate. The main criticism of this consensus mechanism is that it centralizes power among the people who have the most tokens. So again, what the market radicals call democracy. And that is probably the biggest problem I have with all these proof-of-stake currencies. But I still don't find a convincing argument to use proof-of-work. As we saw in the beginning with the Ethereum fork, the power dynamics are also flawed in proof-of-work. You might be a little confused here. Ethereum only switched to the proof-of-stake system after the entire fork debacle. In proof-of-work, it's still the people with the most money that control everything. The only difference is that the guy with the biggest data center has all the power, not the guy with the most tokens. But I do not want to talk too much about proof-of-stake since it works reasonably well and does what it is designed to do. To conclude, there are plenty of cryptocurrencies that I would consider convenient to use. They use the more efficient proof-of-stake system and have a block time that makes transactions fast enough for most use cases. But nonetheless, they still all suffer from this disproportionate power distribution. But to be clear, from a technical point of view, my main beef is with Bitcoin. Bitcoin irritates me, especially since it is by far the most popular cryptocurrency despite being technically inferior to the mass of alternatives. And I believe that this highlights a fundamental thing about crypto. While this facade of technical complexity is extremely important for its image, most people who actually buy it could not care less how it works. The whole technical side is not relevant at all. It's just clever marketing to hide the fact that you are not buying anything at all. To conclude this second part of the video, cryptocurrencies are a cool technology, even Bitcoin, which I hate on a lot here. I am sure the original people that came up with crypto are very competent programmers. I just feel that today modern alternatives that are built on the foundation Bitcoin laid are far superior. But to summarize the points of this section, the technology is inherently flawed. There are trade-offs in decentralization, especially when it comes to transaction throughput and the fact that people with more money have more control. I do not believe that these flaws doom the technology completely. It is evolving and I can see it being useful in some applications. But ultimately, the technology does not matter. What matters is the impact it has on the real world. And with that, I want to transition to the third part, the material.
I am right now independently. Financially independently. I am saying to so many people who said that this was going to be a con artist game, that this was going to be a scammer game. Hey, you're going to lose all your money. My wife still doesn't believe in me.
If you were paying attention, you might have noticed that I did not discuss the last criterion of currency, volatility. I left this third criterion out in the last part because the point I wanted to make is that crypto is a horrible currency from a technical point of view. But do not worry, I will finish arguing why crypto is generally horrible as currency. First, I want to highlight a few other material aspects and then conclude this video by telling you why crypto is so volatile. Let's now dive into the final chapter, the material. You might be a bit confused why I've decided to dedicate an entire chapter to the material. That is because for all of its marketing of existing in this ethereal realm of technology, crypto exists on actual hardware. We started to see this in the last chapter. Proof of work, crypto mining happens on actual hardware, on computer chips and GPUs, not somewhere in the clouds. So while the value of crypto might be imaginary, the consequences of completely unregulated speculation are not. So let me start by explaining the concept of the infrastructure. When I say this word, you probably think about bridges and roads, but there are a lot more infrastructures we don't think about a lot. That is because it is a fundamental quality of the infrastructure that is transparent. It only becomes apparent upon breaking down. You never think about rail infrastructure until the train you take every day arrives too late. You do not think much about the power grid unless the lights suddenly go out. We in our modern world rely on a massive amount of these invisible infrastructures. Just to watch this video you need a working power grid, network switches, fiber optic cables spanning the globe, as well as a bunch of data centers. These are material things that need to be maintained by someone. The market radicals we discussed in the first chapter will have you believe that it makes sense to privatize all infrastructures. And this privatization project has been pushed in many countries since the 70s. But if you look at the actual results of privatized infrastructure, for example, trains in the UK, you will see that it's an absolute disaster. It is not within the scope of this video to explain why half a century of privatization has been one of the biggest tragedies of recent history, but I will leave that for another time. To get back to topic, I will tell you about one of the most genius marketing tricks ever pulled. It is the cloud. This term, cloud, it is not even strange to us anymore. But at some point, a few big tech executives had the idea to offer the product we now call cloud storage. That is, they said, just give us all your data, we will store it on our servers, and pinky promise that we will not do anything sketchy with the petabytes of data we collect. Today we are used to this idea. We do not really care anymore. But you have to realize how radical that was at the time. So a bunch of marketing people had to sit together and make this practice sound inviting. They decided to call it the cloud. That is because, the clouds, they're everywhere and nowhere. Don't be ridiculous, you're not storing your nudes on my hard drive. No, it's in the clouds, it's somewhere, it's nowhere. It doesn't matter. It's like magic, don't worry about it. What these marketing people came up with is called infrastructure concealment. They hide the very material infrastructure that is behind the product that they are selling. That is why half this video is about how crypto actually works. Because 90% of the marketing for crypto is essentially the same as the cloud. All your money is stored somewhere in the magical blockchain. You don't know what a blockchain is? It doesn't matter, it's a very advanced technology, it's great, you should put all your money in there. It's wonderful and decentralized and super safe. But your money is not in the clouds. Your tokens are not in the magical metaverse doing jujitsu with Mark Zuckerberg. They are ones and zeros on a bunch of computers somewhere. And people own these computers. And the internet is not just some realm disconnected from reality. And as much as I would wish for it, the network infrastructure and power grid is not always owned by the society. It is owned by private individuals and companies. So this entire ideal of decentralization is worthless. Because the kind of decentralization crypto has does not democratize anything. It just gives even more control to the few rich assholes who already decide everything anyway. And what makes this even worse, at least when the crooks and thieves at PayPal and MasterCard take a cut from your transaction, they compute the stuff in a way that is actually energy efficient. If it was not obvious, crypto mining is an environmental and human catastrophe. According to the US Energy Information Administration, as of January 2024, the estimated power consumption of Bitcoin alone was between 9 and 44 gigawatts. That is with giga. For reference, an average nuclear power plant produces 1 gigawatt. The biggest dam in the world, the Three Gorges Dam in China, produces 22 gigawatts. So the estimated power consumption of Bitcoin ranges from half this dam to 2 times this dam. And in case you're just listening to this video, this thing is enormous. It is huge. And do not forget, this is all for mining Bitcoin alone. As I explained in the last chapter, mining is a Sisyphus task. It does nothing. It is completely useless and stupid. It does nothing except waste energy and warm up our planet. But this is not all. You're not just wasting energy. Crypto mining requires hardware. It requires tons of GPUs and computers. All this hardware requires resources. All the rare earths and metals that go into making GPUs, that stuff has to be mined by someone. And not the goofy Sisyphus mining, the real actual mining that fills your lungs with toxic dust. It probably won't surprise you when I tell you that the working conditions in these mines are not exactly great. Human beings, including children, sacrificed their health and sometimes even their lives to dig out these resources. And for what? So you can buy yourself a stupid image of a monkey? This is completely perverted. It goes against any semblance of reason. It is indicative of the world we live in today that instead of, not printing a shit ton of money to bail out big banks and maybe creating an open standard for financial transactions, we have to invent this completely idiotic, wasteful charade of crypto, which is the least efficient way of solving our problems, with the caveat that it doesn't even solve anything at all. But to be real here, no one cares about cryptocurrencies as actual currencies. Because there are a few coins out there that I could see being used for actual transactions. But it's just a few nerds who buy those coins. The big popular one is Bitcoin. And as I explained earlier, Bitcoin sucks as a currency. But the people who buy Bitcoin know that. They know it is not a good currency. They know it has no real world value. So that's why they call it an investment. But I disagree with that terminology. If I invest in something real like a gravel quarry, I give some of my money to the owner so that he can buy more trucks or whatever you need to run a gravel quarry. I wouldn't know, I'm a nerd who has never done any manual labor in his life, but my point still stands. I give the quarry owner money to buy more trucks. He can produce more gravel, make money, and therefore pay me back with interest. That is an investment, an actual investment in the real sense of the word. I give the quarry owner money because I believe that he is a competent manager of the quarry and will be able to generate profits in the future. You can stretch this concept a little bit and then you get stocks. There you get a part of the company. With stocks, the expected growth is usually already included in the market price. If you want to buy a stock of the gravel quarry, you will have to buy it from someone. That price will include how much the quarry is actually worth, so all the trucks and land and all that stuff. But if the CEO is competent, no one in their right mind would sell me that stock for just the value of all the assets. Because this expected growth is already factored into the market price. Now, maybe I am a corrupt politician, and I know I will free the gravel quarry from some environmentalist burden or something, give them some tax cuts. Then it makes sense for me to buy that stock at the market price because I know the growth will be higher than everyone selling the stock expects. Even if tomorrow everyone decides that they have mass hysteria and want to sell the stock, it will still have its value, as long as the quarry produces and sells gravel. And even if the CEO is an idiot who mismanages everything, at the end of the day the value is still backed by all the trucks and the land and that stuff. Notice how I never said the value of a stock goes up or down. I say the market price or the value you receive upon selling fluctuates. That is because the value is not the same. The value is the value of all the assets and the real world stuff that is produced. If a stock sells for a lot more than it is worth, that means people expect it to make big profits and buy new assets or pay out dividends. Usually with stocks, the market price is a lot higher than the actual value because we expect that a even moderately competently run business will grow at least a little bit. The business people measure this with a concept called price to earnings ratio. If you go look at something like a tech startup, you will see that the value is quite small. They might have a few chairs, desks, computers, and a few lines of code. But with tech startups, the expectation is that they will grow really fast and become tech giants. At which point they are able to do stuff like steal a shit ton of data and sell it to advertisers. That is why tech stocks sell for such a high price. They are not actually worth that much. People just gamble on the fact that a lot of tech companies have the potential for explosive growth. And if a tech company has a decent product, this might even be a reasonable gamble. But I still refuse to call it an investment, since usually you are buying that stock from another person that has nothing to do with the company. The person that sells you that stock just happens to believe that the company will not grow as much as you believe it will. But notice that even with tech companies that fail all the time, you are gambling on something. There is some sort of product. Even the fucking Juicero is a product. Even there is something, even though it's completely idiotic. Like, at least it's material. There's something there. A perfect example to illustrate what the price to earnings ratio means is Tesla. Tesla stock price is completely divorced from the value of the cars they produce. The only reason the Tesla stock is so expensive is because the Elon meat riders do nothing but like glazing him and keep buying it. And the second Elon shows how deranged he is in such a public way that even those mongoloids realize it, the stock immediately crashes because it was never connected to the cars. Now let's finally talk about volatility. I feel like this is the most obvious problem of crypto. But for the sake of making a complete argument, I will elaborate anyway. The immediate problem is crypto is ones and zeros. It's nothing. It has nothing backing its price. Or, to put it better than I ever could,
it's all a fugazi. You know what a fugazi is?
No, fugazi. It's a fake.
Yeah, fugazi. It's a wazi, it's a woozy, it's a fairy dust. It doesn't exist. It's never landed. It is no matter. It's not on the elemental chart. It's not fucking real.
To make my point, I will show you some numbers. This is from the US Federal Reserve. It says there are currently around 20 trillion US dollars in circulation. This is not just banknotes, but also digital currency. The currencies of medium nations usually have the equivalent of a few trillion in US dollars in circulation. The US dollar is the de facto currency of world trade. Now imagine how many microchips, how many houses, how many tons of steel, how many barrels of oil get traded with US dollars every day. It's pretty hard to estimate exactly, but it's probably a very large number. Now imagine the same for the biggest cryptocurrency, Bitcoin. How many actual material things get bought and sold with Bitcoin? And I don't mean ugly pictures of apes or other fictional currencies. I'm referring to things of real material value. Almost nothing. But nonetheless, the market cap of Bitcoin, so the price of all Bitcoins, is around 2 trillion US dollars. This is absurd. It is more than most currencies of small countries. It is almost a tenth of all the US dollars in circulation. The price of cryptocurrencies does not come from them being a medium of exchange. It is purely speculative. You can argue that something like the US dollar has no material value, and that is partially true, but at the end of the day, it's still backed by a massive imperial power. The world's largest military occasionally goes out of their way to overthrow governments just so that the global oil trade is denominated in US dollars. Well, yes, the actual paper note and the number in your bank account does not have real value. The amount of trade that happens with US dollars and the amount in circulation are proportional to the real world power US hegemony exerts over the world. Of course, I will not sit here and argue that the US government is managing their currency in the interest of the people of the world or even their own people. But I am not arguing the current system is good. I want to illustrate how much material power and actual practical value from it being a useful medium of exchange is behind the price of real currencies. So the fact that Bitcoin has even 1/10 of the market cap of the most important currency in the world is completely absurd. The only material power backing the price of Bitcoin is a few rich people who own data centers and refuse to sell their Bitcoins for less than the price of the power they wasted mining the things. So even if there are some cryptocurrencies that might be useful as currencies, the entire sector is completely inflated. The price of cryptocurrencies is completely detached from the material reality of the benefit they provide from being a medium of exchange. But with Bitcoin, there is nothing. While there might be a few cryptocurrencies out there that do not suck as actual currencies, Bitcoin is definitely not one of them. And most people who buy it know that. No one buys Bitcoin with the intention of buying something with it. They all buy it as what they call an investment. In reality, it is not an investment. Because there is no product to invest to, or to be clear, no one cares about the product. When you are buying Bitcoins, you are gambling that at some point there will be another idiot who is willing to pay you more money than you had to spend on them yourself. Sometimes people who own Bitcoins will see the line go up and say, look, I made $200 today. But no, you made nothing. That number does not mean anything unless you sell the Bitcoins for that price. Because even when no one wants to buy your gravel stocks, they will still be worth as much as the trucks and the land the company owns and the value the company creates. But if no one buys your Bitcoins, you are shit out of luck. So with Bitcoins, the gamble is not that the line goes up while you own them. The gamble is that the line is up when you decide to sell. But by definition, it is a zero-sum game. The gravel quarry generates new value by creating gravel. The Bitcoin product does not create anything. Actually, it deletes value, it wastes energy. It is not a zero-sum game, it is a minus-sum game. There cannot be more people that get rich than people who lose all their money. So if you own Bitcoins, even if the line is going up, at some point you will have to sell them if you want to buy anything that is not a picture of a bored ape or fucking drugs in the darknet. The people who are losing just don't know it yet because all they see is a number that keeps going up. Until now they were lucky that there are a bunch of investment gurus that get enough dumbasses to buy into the scam. But at some point there are just not enough people left in the world that are gullible enough to buy. It's literally a Ponzi scheme. That is why crypto is so volatile. Each time it slightly dips, every rational person thinks, it's the house of cards is about to crash, it's time to cash out. And all the crypto people with half a brain cell know this. But they don't want to sell now, they are like Icarus. If you keep flying closer to the sun, at some point your wings will melt. But instead of selling now or accepting that they might gamble away their entire money, they are now already starting to force the Federal Reserve and other national banks to buy these valueless tokens for their imaginary market price. What this essentially means is that all the normal people who don't want anything to do with this crypto insanity have to bail out everyone at the bottom of the pyramid. And all the crypto people get to claim that they are genius investors when in fact all they are doing is stealing from the public. This makes me furious because when someone like the Argentinian president Javier Milei or Donald Trump does a crypto rug pull, I don't care. If you're stupid enough to fall for Milei's crypto scam, you deserve to lose all your money. I spit on the people who fell for a scam and I spit on the people who support Donald Trump. But what pisses me off is that now there are even people in my country of Switzerland that are advocating for the national bank to buy crypto as a reserve currency. Just imagine, at the end of the story, Icarus does not fall from the sky and die as a punishment for his hubris, but instead his wings melt and he lands in a crowd of people. Some of the people die, but he survives, and then he walks around Greece telling everyone what a genius he is and how he planned for his wings to melt and to land safely in the crowd. If that was the story, everyone would hate it. But the story of Icarus survived for thousands of years, and I am trying to be like the wise Daedalus. So I will tell you, do not buy into the crypto madness. Do not challenge the gods by flying too close to the sun. But alas, Icarus did not listen and he will crash. So I am begging everyone, do not sacrifice yourself to soften the blow. Do not support your government buying crypto. Because the just punishment for hubris is death. And nothing in this world could make me happier than seeing the crypto people's bones shatter as they crash into the hard ground of reality.